implementation of sweeping tariffs by the Trump administration in April 2025 is poised to have profound and lasting effects on the global economy over the next decade. Drawing from the latest analyses and projections, here's a comprehensive outlook on how these policies may reshape economic dynamics by 2035. U.S. and global GDP slowdown. The tariffs are projected to reduce U.S. GDP by 0.7% annually in the short term, with cumulative effects potentially deepening if trade wars escalate. By 2035, this could translate to a 5 to 10% smaller U.S. economy compared to a no-tariff scenario, with spillover effects dragging down global growth. Stagflation. Higher import costs may lead to persistent inflation coupled with stagnant wages and employment, reminiscent of the 1970s. The IMF warns of a lost decade for emerging markets like Vietnam and Cambodia, where export-dependent economies face GDP declines of 1 to 2% annually. Partial reshoring. While tariffs aim to revive U.S. manufacturing, sectors like autos and semiconductors may see limited success due to high domestic production costs. Estimates suggest only 20 to 30% of offshore jobs could return, with automation further limiting employment gains. Supply chain balkanization. Companies will diversify away from China, but not necessarily to the U.S. Southeast Asia. Vietnam, Thailand and India may benefit initially, though Trump's tariffs on these regions, for example, 46% on Vietnam, could accelerate China Plus 2 strategy, favoring Mexico and Eastern Europe. Erosion of U.S. alliances. Retaliatory tariffs from the EU 20%, Canada 25%, and China 34 to 84% may solidify alternative trade networks. The EU and China could deepen partnerships, while Asia pivots toward regional comprehensive economic partnership or CEP-style agreements. Resource nationalism. Critical minerals, for example, copper, rare earths, may face export restrictions by producer nations, for example, Indonesia, South Africa, exacerbating shortages for green tech and defense industries. Automotive industry. Trump's 25% auto tariffs could shrink global auto trade by 15% by 2030, with U.S. consumers facing $5,000 plus price hikes per vehicle. Electric vehicle adoption may slow due to costlier Chinese battery imports. Agriculture. U.S. farmers could lose $50 billion annually from retaliatory tariffs, for example, China's 34% duty on soybeans, accelerating consolidation and pushing smaller farms out of business. Tech and pharma. Semiconductors and pharmaceuticals, initially exempt, may face future Section 232 tariffs, disrupting R&D investment and delaying drug, tech innovation. Regressive impact. Tariffs act as a hidden tax, costing U.S. households $1,900, $5,200 annually by 2025, disproportionately hurting low-income families. By 2035, wealth gaps may widen as capital owners benefit from protectionism while workers face job volatility. Political instability. Rising costs could trigger populist backlashes in the U.S. and abroad. Countries like Cambodia, where 750,000 garment jobs are at risk, may see unrest, while U.S. midterm elections could hinge on tariff-induced inflation. Carbon leakage. Tariffs may push production to countries with weaker environmental standards, for example, Bangladesh, Myanmar, increasing global emissions despite U.S. manufacturing gains. Innovation slowdown. Reduce global collaboration in tech, for example, AI, clean energy due to trade barriers could delay breakthroughs, ceding leadership to China in sectors like renewables. In summary, by 2035, the world may bifurcate into competing trade spheres: a U.S.-centric bloc with managed trade and a China, EU-led multilateral order. While tariffs could marginally boost U.S. manufacturing, the broader costs higher prices, slower growth, and geopolitical friction may outweigh benefits. The ultimate trajectory hinges on whether tariffs are rolled back post-Trump or become entrenched, akin to the Smoot-Hawley legacy of the 1930s.